While dealerships are desperately trying to hide the signs, a tsunami of used vehicles is about to slam into the American market with devastating force. They told you cars were investments. They lied. Behind the scenes, banks, automakers, and rental fleets are unloading cars at a pace no one's seen before. But it's not them who will pay the price. It's you, left with a vehicle worth far less than the loan you signed. What if I told you that 5 million cars are about to flood dealerships nationwide, creating a supply shock that will instantly devalue your vehicle by thousands? This isn't just another market correction. It's an unprecedented collapse that's already forcing dealers to slash prices weekly just to clear space for the next wave of inventory. And here's what makes this truly terrifying. This flood isn't coming from just one source. It's a perfect storm of repossessions hitting record levels, rental companies dumping entire fleets, and the first massive wave of electric vehicle lease returns all converging at exactly the same time. The result? A market drowning in supply with nowhere near enough buyers to absorb it. The truth is, this used car tsunami wasn't caused by typical market forces. It was triggered by specific policy decisions and financial miscalculations that created a ticking time bomb in the automotive sector. That number, 5 million cars, isn't just large, it's unprecedented. To put it in perspective, it's more vehicles than every dealership in the United States normally sells in an entire quarter. What's truly shocking? The collapse was actually set in motion by a single line of fine print buried in legislation that was supposed to help the environment. This seemingly minor detail created a lease return schedule that's about to overwhelm the market in ways even industry veterans have never seen before. Even more alarming, while everyday Americans are about to watch their automotive investments plummet in value, certain corporate giants are quietly positioning themselves to capitalize on this disaster. The coming price collapse isn't a misfortune for everyone. It's an engineered opportunity for those who knew it was coming. Why are lenders tightening overnight? Why are EV values dropping like a stone? And why are auctions rewriting prices every single week? To answer these questions, we need to look at the unprecedented volume of used vehicles about to hit the market and the multiple streams converging to create this perfect storm, the number that breaks the market. 5 million cars are about to slam into the American market, and the industry has no brakes strong enough to stop it. That number is not just large, it is unprecedented. To put it in perspective, it is more vehicles than every dealership in the United States normally sells in an entire quarter. Repossessions are stacking up at record levels. Rental fleets are liquidating at a pace the market has never seen. And electric vehicle lease returns are scheduled to arrive in tight batches that will overwhelm auctions. All these streams of supply are converging at once, threatening to drown dealers in unsold inventory and collapse prices in ways even seasoned insiders have never witnessed. For years, the used car market defied gravity. Families paid record sums for ordinary sedans, trucks, and SUVs. Lenders stretched credit. Manufacturers throttled new production, and rental companies hoarded fleets. But now the pendulum is swinging violently the other way. Auction lanes are overflowing, dealer lots are packed, and buyers know it. Consumers are no longer rushing to grab whatever sits on the lot. They are standing back, waiting for discounts, sensing that prices are about to fall further. This hesitation adds fuel to the fire, leaving dealers with metal they cannot move and lenders with collateral that bleeds value by the week. As the floodgates open, it becomes clear that this wave of cars will change everything. But the real question is, how did we get here? The lease loophole that loaded the cannon. The Inflation Reduction Act was pitched as a green revolution, but one line of fine print created a tidal wave no one fully anticipated. In the text, lawmakers allowed leased electric vehicles to qualify as commercial sales. That simple technicality unlocked a federal tax credit worth $7,500 per vehicle, a subsidy that banks and automakers were eager to claim. Instead of the benefit flowing only to buyers, lenders passed much of the savings into cheaper monthly lease payments. Overnight, electric vehicles that might have cost hundreds more each month suddenly looked affordable, sparking a leasing boom. In 2022, only about 15% of electric vehicles left showrooms under lease contracts. By the spring of 2025, that figure had surged to more than two-thirds. The math is staggering. Industry trackers estimate that 123,000 leased electric vehicles will return in 2025. In 2026, that number jumps to nearly 330,000. By 2027, roughly 650,000 will come back. In only 3 years, more than 1 million late-model electric vehicles will be pushed into the used market, regardless of whether demand exists to absorb them. Dealers cannot stretch parking lots, and buyers will not overpay when newer, better models keep arriving. That is why insiders call the leasing loophole a time bomb. While the market was already on edge, a simple change in legislation set the stage for a much bigger crisis, one that no one saw coming. If you're finding this surprising, don't forget to like and comment below. We're diving into some pretty shocking truths, and I'd love to hear your thoughts. Have you noticed any of these shifts in the market yet? Let me know in the comments. This conversation is just getting started. When Hertz blinked. Hertz believed it was leading the future when it ordered 100,000 Teslas for its rental fleet in 2021, but that gamble became a nightmare. Electric vehicle values dropped faster than the company could depreciate them, leaving Hertz with hundreds of millions in losses. By early 2024, the company admitted defeat and announced it would dump 40,000 electric vehicles, most of them Teslas, into the market. That liquidation was not a slow trickle. It was an avalanche that undercut every dealer already struggling to move similar cars. Auction houses that normally welcomed late-model, low-mileage rentals suddenly faced row after row of identical vehicles. Buyers knew Hertz was desperate. Bids came in low. Prices for competing models plunged, and ordinary drivers noticed the ripple effect. A contractor in Ohio who had stretched to buy a truck at the top of the market saw its value fall by thousands in a matter of months, dragged down not just by repos and lease returns, but also by a rental giant that needed to clear its books. Hertz's decision sent a chilling message across the industry. If a major corporation could not make electric vehicles pencil out, what chance did smaller players have? But Hertz was just the match. The real fire is burning on every dealer lot every single day. The crisis unfolding in the used car market isn't just about numbers on a spreadsheet, it's about real financial pain hitting everyday Americans where it hurts most. As this massive supply flood continues, the impact is escalating from concerning to catastrophic for millions of car owners. Consider this. The average American who bought a used car during the 2021 to 2022 price bubble is now facing negative equity of over $11,000. That means they owe the bank thousands more than their vehicle is currently worth. And with each passing week, that gap is widening as auction prices continue to plummet. For families already struggling with inflation across other necessities, watching their car's value collapse while their loan balance remains fixed creates a financial trap with no easy escape. Selling means coming up with thousands to cover the difference. Keeping the vehicle means watching its value continue to fall while making payments on a depreciating asset. But the stakes extend far beyond individual car owners. The entire automotive ecosystem is now at risk of systemic failure, the interest meter that never sleeps. Walk onto any dealership lot and you might think those shiny cars belong to the owner. They do not. Nearly every sedan, truck, or SUV is financed through a system called floor plan credit. Dealers borrow money to stock their inventory. And every day a car sits unsold, the bank charges interest. When vehicles sold in days, the cost was manageable. Now, with inventory sitting for weeks or months, the math is devastating. A dealer carrying 200 cars can rack up tens of thousands in interest before a single sale clears the books. This constant meter does not pause for weekends or holidays. Every sunrise adds more cost, and each week that passes shaves profit off the final sale. Some dealers slash prices just to stop the bleeding, selling at a loss because holding on is even worse. Others fall behind and watch lenders seize their inventory, hauling it to auction where it joins the flood of repossessions and lease returns already pushing prices down. The system once designed to keep lots full is now crushing the very businesses it was supposed to support. For thousands of small-town dealerships, it has become a ticking time bomb. While corporations scramble to recover, another unseen force is quietly tightening its grip. The pandemic playbook. How we got here. The story of today's collapse cannot be told without looking back at the years when cars stopped behaving like cars and started behaving like gold. When the pandemic struck, factories went silent, supply chains cracked, and new car production in the United States sank to levels not seen since the Great Recession. In 2020, output cratered to just over 13 million units, leaving dealers scrambling to stock anything with four wheels. That sudden scarcity turned ordinary sedans and pickup trucks into objects of frenzy. Families who once negotiated for discounts found themselves bidding thousands above sticker just to drive something home. Cheap credit poured gasoline on the fire. The Federal Reserve slashed rates near zero and lenders stretched auto loans to 7 years or more. Monthly payments looked manageable even as prices soared. A pickup that would have sold for $35,000 before the pandemic now commanded nearly $50,000, and buyers lined up anyway. Even the most unremarkable cars, the Camry, the Accord, the Civic, saw values rise month after month. People told each other that cars were investments, appreciating assets that could be flipped for profit. It was an illusion built on scarcity and easy money, and like all bubbles, it could not last. But what goes up must come down. What started as an emergency response quickly turned into an unsustainable trend, creating a bubble that would soon burst with catastrophic consequences. The repo machine. Every morning across America, thousands of repossession trucks set out before dawn. Their mission is blunt: recover vehicles from households that can no longer make the payments. In 2024 alone, an estimated 1.73 million cars and trucks were repossessed, the highest tally since the dark days following 2009. For families already stretched thin by rising rents, medical bills, and food costs, a $700 car payment became the breaking point. The human toll is devastating. A single mother in Michigan misses 2 paychecks and wakes to find her only way to get to work hooked to a tow rig. A delivery driver in Texas loses his van and with it his livelihood. Negative equity compounds the pain. The average repossessed borrower still owes over $11,000 even after the car is auctioned off. These debts linger for years, damaging credit and draining savings. But the repossession crisis is not just personal tragedy. It is also raw supply hitting the wholesale market. Each car taken off a driveway ends up in the auction lanes within weeks, competing with thousands of others just like it. Prices at these sales collapse under the weight of inventory, dragging retail values down with them. Yet repos are only half the story. Another river of cars is pouring in straight from the rental lots. The rental river turns into a waterfall. Rental cars used to be the quiet workhorses of the used vehicle market. Companies like Enterprise, Avis, and Hertz regularly cycled out millions of vehicles each year, feeding dealers with reliable late-model stock. Under normal circumstances, this flow was predictable and digestible. But today, the flow has turned into a flood. Rental giants burned by plunging values and struggling with higher operating costs are unloading inventory at a speed the market cannot absorb. In a typical year, close to 2 million rental vehicles shift from airport lots to the used pipeline. Now the pace is even faster. Hertz's headline liquidation of 40,000 Teslas made news. But the broader story is that every major rental company is cutting back fleets and pushing cars into wholesale. These are not clunkers. Many are 1 or 2 years old with low mileage, the kinds of cars that used to fetch a premium. Yet, with rows upon rows arriving at auctions each week, buyers know they can wait. Dealers bidding at wholesale are slashing their offers. confident that another wave is coming right behind. This sudden waterfall of rental units collides with repossessions to create a surplus the market has never seen. The true revelation in this market collapse isn't just about volume, it's about how the entire system of vehicle valuation is being fundamentally rewritten in real time. We're witnessing something unprecedented. A market where price discovery happens through panic rather than rational assessment. What's truly shocking is that the flood of inventory isn't just changing what cars are worth, it's changing who decides what they're worth and how those decisions are made. For decades, guidebooks like Kelley Blue Book served as the industry Bible for vehicle values. But those traditional pricing mechanisms have completely broken down. In today's collapsing market, cars are worth whatever desperate sellers will accept and nothing more. The guidebooks now lag reality by thousands of dollars, creating a disconnect that's fueling even more panic selling as owners realize their vehicles are worth far less than official values suggest. This unprecedented situation reveals a bitter truth about the modern automotive market. It was built on financial engineering rather than manufacturing quality. The industry became dependent on artificial scarcity, easy credit, and financial sleight of hand. Now that those props have been kicked away, we're seeing what vehicles are truly worth when market fundamentals reassert themselves. The math that forces discounts. For a dealer, every car is a clock ticking in dollars and cents. Vehicles are financed through floor plan loans, which rack up interest charges every single day a car sits unsold. When inventory moved in under 2 weeks, those carrying costs were manageable. But now, with average days to turn stretching past 40, the math becomes unbearable. By the time a car finally sells, hundreds or even thousands of dollars have already evaporated into interest payments. Dealers are forced into impossible choices: hold the line on price and watch profits bleed away, or cut aggressively and sell at a loss to stop the daily drain. Many choose the latter because the alternative is financial suffocation. Auctions reveal the pattern. Cars that should command $25,000 are moving for $22,000, then $20,000, then $18,000 as supply piles higher. Guidebook values lag behind reality, and dealers who wait for stability are punished when the next auction round comes in even lower. The cycle feeds itself. Lower prices mean lower collateral values, which makes lenders nervous, which tightens credit for buyers, which reduces demand further. It is a spiral downward with no clear bottom in sight. As inventory piles up, dealers are left with a harsh reality. Every day they wait, the cost of holding stock continues to rise, forcing them into a race to cut prices before it's too late. Price discovery in a panic. When a market is flooded with inventory, prices stop being determined by what people are willing to pay. They are driven by sheer necessity. At auction houses across the country, the used car market has entered a phase of frantic price discovery where each vehicle that crosses the block is a test of the floor price. As more cars arrive, dealers, wholesalers, and online platforms must adjust quickly. The pace of price drops is so rapid that traditional guidebooks like Kelley Blue Book can no longer keep up. What was once a reliable gauge of a car's worth is now a distant echo of a market that no longer exists. In this chaos, buyers are not rushing to secure deals. Instead, they wait. They know that with each passing week, prices will continue to fall. Auctions, which once drove prices higher, have now become the place where those same cars are dumped in bulk. For dealers, this creates an uncomfortable reality. Their inventory is worth far less than it was just a few weeks ago. The scramble to sell is real, but it is also futile as prices are being reset in real time. And while many are hoping for stability, the only certainty is that prices will continue to plummet. The EV return calendar. As the wave of leased electric vehicles begins its return in 2025, the sheer scale of the problem becomes clearer. The Inflation Reduction Act may have made electric vehicles more accessible in the short term, but it has also set the stage for a glut of nearly new EVs hitting the market all at once. By the end of 2025, over 123,000 leased electric vehicles will flood back into the market, and this number will only increase in the following years. By 2027, over 650,000 electric vehicles will be up for resale. What makes this even more problematic is that electric vehicles do not retain their value like traditional cars. Rapid advancements in battery technology, price cuts from automakers, and growing concerns about battery longevity have already created a scenario where used EVs lose 20 to 30% of their value almost immediately after they are driven off the lot. A car that was leased for $50,000 in 2023 might only fetch $35,000 or less on the used market within 2 years. This rapid depreciation is creating a scenario where lenders are facing significant losses on lease returns, further tightening credit for new purchases. Payments, rates, and the illusion of affordability. While the falling sticker prices may seem like good news for buyers, the reality is that the market is not nearly as affordable as it appears. The true cost of owning a car is not just about the price on the window, it is about how the payment fits into a buyer's budget. And right now, that payment is growing harder to afford. The Federal Reserve has raised interest rates aggressively, tightening the credit market. As a result, fewer buyers are able to qualify for loans, and those who do are facing higher monthly payments due to rising rates. The average used car payment is already at an all-time high of $733, and for many, this payment is stretching their budgets to the breaking point. A growing number of buyers are now stuck in negative equity, owing more on their vehicles than they are worth. Adding to the strain, lenders are demanding higher down payments and more stringent credit qualifications, making it harder for subprime borrowers to secure financing. In this environment, many buyers are opting for longer loan terms, which may reduce the monthly payment but increase the total interest paid over the life of the loan. The dream of owning a car is fading for millions, and what was once seen as a necessary purchase has become an increasingly unaffordable burden. Remember how we started this video discussing the tsunami of 5 million vehicles about to slam into the American market? Now you understand why this isn't just another market correction. It's an unprecedented convergence of multiple supply streams. Repossessions at record levels, rental fleets liquidating faster than ever, and the first massive wave of EV lease returns all hitting at once. The used car bubble that began during the pandemic, when vehicles bizarrely transformed from depreciating assets into appreciating investments, is now violently bursting. And just like every bubble throughout history, the collapse is proving far more sudden and severe than most predicted. For millions of Americans who bought vehicles during the price peak, the financial consequences are devastating. Negative equity is now the norm rather than the exception, with the average underwater loan exceeding $11,000. Each week that passes sees values drop further while loan balances remain fixed, widening this financial trap. Dealers face their own version of this nightmare as floor plan interest meters tick relentlessly on inventory they can't move without taking significant losses. The choice between selling at a loss today or a bigger loss tomorrow has created a race to the bottom that's accelerating the price collapse. Meanwhile, as we've revealed, certain corporate giants with deep pockets are positioning themselves to capitalize on this disaster, buying distressed inventory at pennies on the dollar and consolidating power in a market that will eventually stabilize just at much lower price points. Who wins in the collapse? In times of crisis, the weak are swept away and the strong seize control. As the used car market continues to crash, a handful of corporate giants are positioning themselves to profit from the chaos. Large dealer groups, online platforms, and even automakers are capitalizing on the collapse, buying up inventory at discounted prices and setting up new business models to benefit from the shifting dynamics. Online car marketplaces like Carvana and Vroom, which had once relied on a high-growth model, are now finding success in buying vehicles at depressed prices and flipping them for profit. At the same time, traditional dealerships are consolidating, with major groups acquiring smaller, struggling lots to expand their footprint. The automakers themselves are making moves to secure future profits, with some opting to buy back their own cars at auction or create partnerships with online platforms to control their inventory. For the big players, this collapse is not the end, it is a massive opportunity. They are using their size and resources to weather the storm and emerge on top. The playbook for buyers and investors. For buyers and investors, the chaos in the used car market presents both danger and opportunity. The falling prices of used cars may seem like a boon for consumers, but the reality is far more complex. Buyers who want to take advantage of the current market must be prepared for the risks involved. Falling prices can lead to negative equity quickly, leaving buyers owing more than their vehicles are worth. However, for those who have the cash to buy outright, the next few years could provide a once-in-a-lifetime opportunity to purchase quality vehicles at steep discounts. The key is timing, waiting long enough for prices to find their floor, but not so long that competition from other bargain hunters begins to drive them back up. For investors, this market collapse is a chance to buy distressed assets. Many dealerships are closing or selling inventory at rock-bottom prices. Online platforms that were once the underdogs are now moving in to acquire inventory and expand their market share. Large corporate players with deep pockets are seizing the opportunity to consolidate, snapping up dealerships and other assets at fire sale prices. They know that the market will stabilize eventually, and when it does, they will be well positioned to dominate. As we watch this historic automotive market collapse unfold, one thing is certain: the industry that emerges from this crisis will look fundamentally different from the one that entered it. The winners will be those who understood the true nature of the collapse and positioned themselves accordingly. The losers will be those who clung to the illusion that cars could defy gravity and appreciate in value forever.